after that, since COVID, the real GDP numbers have gone to whatever, barring let's say the dead cat bounce, or let's say a recovery number of 10%, the more stable state is like 6 and 7% real GDP growth. But the point is, question to ask is, why has suddenly the numbers of GDP, real GDP growth, why have they changed between the first 6 years and the next 4 years, which is 2020 till 2024? And the answer is very simple. Look at the public debt to GDP numbers of India, starting from 2004. India was at about 90% public debt to GDP. That came down in the next 10 years, which is 4 to 14, to about 65, 66%. From 2014 till now, we have gone back to the approximate, let's say numbers vary, but between 85 and 90% public debt to GDP. And of that, a large buildup has also happened in the last 4 or 5 years' time. So our growth, and that is number one. Number two, our fiscal deficits, which were around 3-4%, which is more like the norm, has now been normalized to like a 5-6% new normal in the last 4 years. We understand there was a COVID year, we needed to pump prime the economy. But now, when we say fiscal prudence, I laugh that running a 90% public debt to GDP and a 6% fiscal deficit cannot be called fiscally prudent. That used to be a very different set of numbers. It's just that we have normalized very high public debt to GDP numbers. We have normalized a high fiscal deficit number. And now the market has been messaged that, okay, we will now ratchet it down in the fiscal glide path to 5%, then 4.5% over whatever 1 or 2, 3 years. But the point is, this Capex-led growth, which has happened in the last 4 years, is ultimately the same growth model that China followed, the same growth model that Japan followed in the 90s. And it always ends badly. Always, without exception, a Capex-led model ends badly, because you end up building a very high public debt to GDP number. You end up building very high fiscal deficits. As a result of that, when you want to ratchet down the deficit, as the government has promised it will, growth just collapses, because you don't have enough firepower to keep pump priming the economy. So that is the core problem here. We have seen good numbers on GDP growth only because of very high fiscal deficits and a very sharp buildup in public debt to GDP. And the other point I want to mention is that, strangely enough, and I don't hear enough talk about it, the combined fiscal deficits of the center and the states and the current account deficit has hovered between 9 and 11% in the last 10 years. Which is about the same as when we were called Fragile 5 in 2013. That time we were about 12%, but remember that was the QE, taper tantrum year in which everything collapsed because it was sudden tapering. And we were coming out of the 2008 crisis. We have still run close to double-digit numbers on the twin deficits, which is fiscal and current account. So it's not that we have suddenly become a very fiscally prudent country. I mean, the data does not support that narrative. And I'm a person of data. I don't care about the politics of it, because that's for other more, let's say, smarter people to figure out. I am a man of data. I'm a man of numbers. This is what the data tells me, that our growth is predicated and based on very high deficits and very high buildup in public debt to GDP. And of course, current account deficit also fuels the growth. So that is the most important thing, that this government changed track suddenly after 2020. It got the license to pump prime growth using COVID as a, let's say, I wouldn't call it excuse, but as a reason to pump prime growth. Because the same government was delivering very abysmal numbers in their first 6 years of being in power. The second point is that coalition governments have delivered very good numbers in the past, as Amitabh, I think, mentioned. So, I mean, I'm not of the school and the belief that, having a Chandrababu Naidu, who was the CEO of Andhra, if you remember, that is how he arrived on the political scene. He called himself the CEO of Andhra Pradesh. The first time we heard of a CM calling himself CEO. All these people understand growth, they understand reforms. It's not that they're going to stonewall anything at all. Sure. A bit of checks and balances are always welcome, just like a company. You expect the board to be responsible and do the right thing for the shareholders, which is the people of the country. Just like the board in a public company, a well represented, diversified board at the cabinet level also is not necessarily a bad thing.
Yeah.
So, final point I'm trying to make is I'm going to make is that just looking at stock market returns, the last 12 years and last 10 years have delivered us around 11 or 12% CAGR, which is again below our long-term trends of 15, 16%. So that is the other important thing to keep in mind. It is just that we have recency bias, that the recent data points tend to become more important in our head. And the recent data points is that last 4 years since COVID have been excellent for stock market returns, but that has come out of a very high fiscal deficit. So the deficit is the fuel which has fueled the stock market rally. Can a stock market fueled by high household debt, which is again at a multi-decade high, and high public debt, which is also the highest I've seen in 25 years, can that kind of economic model deliver stock market returns? I mean, that's a question I don't have an answer to. That will unfold. But I think that's the data part of it. I will leave the politics out of this discussion.